Welcome to Cat Eye US Stock. We watch markets with calm focus and sharp instincts. It's Monday, March 16, 2026, and the market came in with a clear risk-on attitude. Big tech flipped the tape back to the upside, and semiconductors poured fuel on it. It felt like one of those sessions where dips just didn't stick. But it wasn't perfectly clean. One ugly software outlier reminded traders of a hard truth: you can have a green index and still see real single-name damage underneath. On the S&P 500 Heatmap, it was basically a sea of green, roughly 80 to 85% of names higher. And the important part, the biggest boxes were green together. Nvidia, Apple, Microsoft, Google, Meta, Amazon, Tesla, all up, all leading. That's why it didn't feel like index masking. You also had a very visible red pocket, CrowdStrike breaking the board visually. And then the quieter tell, consumer staples like Walmart and Costco bleeding red while everything else was lifting. So what did that heat map actually tell us? It was money rotating toward beta and growth. Semis and the megacap platforms were the liquidity magnets pulling the index higher with real participation behind them. Communication services got support from the platform complex. Financials looked constructive, and the underperformance in staples read like a deliberate re-risking. Safety getting sold, upside getting bought. Even small caps showed up. More rising tide participation than leadership, but still a solid breadth signal. Here's the real tension the market put on the table today. When the generals are green together, it's hard for allocators to stay underweight growth without taking tracking error pain. Semis were the accelerant, liquid leaders plus high beta followers. But at the same time, CrowdStrike was a sharp red outlier inside a green tech tape. Traders will treat that as a stress test. Is it just idiosyncratic damage or a warning shot for crowded software? And meanwhile, defensives didn't provide a safety bid. They lagged. That's a market choosing upside for at least one session. While Nvidia celebrates, Meta is doing some grim math. Mark Zuckerberg just signed a $27 billion check to Nebius to lock in future AI capacity, but that infrastructure comes at a human price. Rumors of a 20% layoff, roughly 16,000 employees, suggest Meta is cannibalizing its own workforce to feed the AI beast. It's a pivot toward a leaner, more machine-driven future where the chips are more valuable than the cubicles. Jensen Huang just turned San Jose into the center of the tech universe. With the launch of the Blackwell B200, Nvidia isn't just iterating, they're accelerating. But the real story is the acqui-hire of Grok. By bringing Grok's ultra-fast LPU talent under the Nvidia roof, they're effectively closing the door on the competition. It's not about graphics anymore, it's about building the AI factory that powers the global economy. Nvidia stayed green today, and it mattered because it's still the market's primary AI beta valve. When Nvidia is bid, traders tend to feel safer adding exposure across high multiple growth. This was one of those sessions where the leadership looked coordinated. Nvidia up, other megacaps green, semis moving with them, and that combo is what made the tape feel risk-on instead of fragile. Micron was one of the brightest green semis on the board today. The read-through in the notes is AI memory and HBM-led momentum, still attracting buyers. MU has turned into a sentiment proxy for the AI infrastructure build-out. When it's showing outsized strength, traders often treat it as permission to lean into the broader chip basket. Meta finished higher, keeping communication services in the leadership mix alongside Google. In the context of this tape, that matters because it reinforces the general's marching setup, strength beyond just semis, and hovering over it all is the human input narrative. AI capacity spending, and layoff rumors. The rumor angle isn't confirmed here, but it's clearly part of how traders are framing the story. Amazon was higher as the market bought growth broadly. And that's the key contribution. Amazon tends to validate whether the tape is chasing upside beyond one AI pocket. With Amazon green alongside the platform complex and semis, the day read more like a coordinated re-risking than a single thumb squeeze. CrowdStrike was the session's visual break in the board, down hard while the rest of tech was mostly green. That divergence really mattered psychologically. The notes frame it as company or industry-specific weakness, and traders will read the move as a test, either idiosyncratic damage or a warning shot for crowded software. Goldman finished higher, and it's a useful cross-check. When brokers and financials are bid alongside tech, the risk-on move tends to feel more broadly supported. It didn't dominate the story the way semis did, but Goldman being green helped confirm this wasn't just a tech-only levitation. Looking ahead, the question is simple: does this risk-on posture hold, or was it just a one-session breath? The watch list is clear. Nvidia and Micron for semiconductor momentum. CrowdStrike for damage control, follow-through selling versus a snapback. SMCI as the high beta speedometer for AI infrastructure. And IWM as the participation tell. If small caps can build on today, it supports that broad risk-on raid. On the macro calendar, Eyes shift to next week's U.S. data. Tuesday's flash manufacturing and services PMIs and Richmond Fed, Thursday's unemployment claims, and Friday's revised University of Michigan sentiment. So that's the snapshot, a broad risk-on session powered by mega-cap tech and semiconductors, with enough participation that it didn't feel narrow. But keep the checklist honest. Staples lagging tells you safety just wasn't in demand. And CrowdStrike's drop is the kind of internal divergence traders won't ignore. Next session, it's all about whether leadership holds and whether breadth stays real. Thank you for watching Cat Eye US Stock. Stay curious, stay calm, and we'll see you next time.